The Bank of Canada is looking to adjust its mandate in order to better deal with inflation as it overshoots the typical bounds that are allowed. And this is something that hasn't been changed since the early 2000s, but given the current state of the economy and what's going on in the labor market, it very well could be something that needs to be adjusted and will be adjusted in the coming months. And I'm going to talk about what all of that means, what it means to you from an interest rate perspective, and so on and so forth. But before we get into it, do me the favor, hit the subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. We are now well over 14,000 subscribers. And when we get to 25,000, we're going to give $5,000 to one lucky winner, one lucky subscriber, just for subscribing to the channel in order to pay off their RRSP, their RASP, their TFSA, or to help pay off some of their mortgage or some of their debt. It's simply up to the winner. Whoever wins gets to decide what they do with the money. But in order to win, you need to subscribe. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit, product, penalty, price in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss inflation and what is going on in the market and what is going on with the Bank of Canada. Because obviously inflation has overshot. There's some conversation about whether or not that is because of base months of last year where there was significantly reduced growth, in fact, little to no growth at all, or if it is going to be something that is sustained over the short term or the long term here. But what is interesting is that now the Bank of Canada, as they renew their mandate, is looking at their options with respect to how to go forward with respect to managing interest rates and managing the economy. Because what is clearly happening here is we're finding ourselves in a situation where we could see high inflation, but also a reasonable amount of unemployment. And therefore, there's some talk about shifting towards more of an employment-oriented framework when it comes to adjusting interest rates and some shifts with respect to looking at the bounds. And I'm going to get into all of that here, but let's jump into, first and foremost, this article from BNN Bloomberg with respect to comments from former Bank of Canada Governor David Dodge. He is suggesting that cash poured into housing, so money that was injected into the economy either through the federal government or through quantitative easing or through lower interest rates, is potentially going to be used up entirely in housing and therefore not going to provide the type of economic growth that is pretty much required in order for the economy to get back to full speed. So basically what he's saying is housing is growing and pulling along the economy because of the low interest rates. However, it is not allowing people to spend money elsewhere, and therefore the type of growth that we need in other sectors may not be there, and something therefore may need to be done. So as a result, what we are seeing is we're seeing some talk about how the Bank of Canada going forward is going to manage this process and manage this basically this controversy and this piece of the economy that they don't normally focus on. Because the mandate of the Bank of Canada for the last 30 years, since the early 1990s, has been all about price control. So making sure that prices of things don't go up too quickly. That's been their mandate. And now what we're seeing post-pandemic is that, yes, there's still some focus, and their primary focus is still on price control, but even with inflation, there is some losses in the job market, and therefore they may need to be looking more at the job market as part of the criteria for what they are going to do with respect to interest rates. So what that means is it means the conversation's changing. They've put out surveys to Canadians. They have done research, and what Canadians have told the Bank of Canada is not only do they want stable price growth, but they want the Bank of Canada to make sure that employment is at full capacity before there are any major changes to borrowing costs. So that potentially means lower interest rates for longer. So here's what's happening. Now the Bank of Canada is sitting here going, okay, what do we do? Well, they clearly need some sort of framework with respect to employment, because yeah, if inflation starts going up, but there's no employment, well, there being no employment limits growth, and eventually that has a negative impact on interest rates and a negative impact on inflation again, because people can't afford to do things with their money because they don't have any money because they're not working. So reshifting this emphasis towards the employment and the employment market could mean that we're going to see lower interest rates for longer because they may want to run at a higher interest rate. And that's what they're asking for, is they're asking the federal government to give them the ability to run a hotter economy in order to get employment back to full employment. And by the way, the Federal Reserve Bank in the US is doing exactly the same thing. So they're asking for this in order to get back to full employment. And that means there may be higher rates of inflation in the future. Now, it could very well be that inflation rates remain low and they still need to have lower interest rates and more quantitative easing in order to get employment back to full steam. But basically what they're asking for is, instead of the change that was made in the early 2000s, which was all centered around aiming for exactly 2% interest rate, or 2% when it comes to inflation, now what they're looking at is going back to the banded framework where they're between 1% and 3% interest rate. And maybe for a while, instead of aiming at 2%, they're aiming at 3%, which would allow them the ability to overshoot without raising interest rates and therefore raising borrowing costs. Because the last thing they want to do is raise borrowing costs when there is massive amounts of unemployment, because higher borrowing costs and low employment leads to, well, the obvious, which is a crash in the economy. So here's what you very well could see. You could see the Federal Reserve Bank in the US and the Bank of Canada acknowledge that higher rates of inflation are okay, which means we could be pushing out increases to interest rates further, not just in 2022, end of 22, but end of 2023, or maybe even into 2024. Because if they're sitting there going, we need employment to come back to full steam, and the conversation changes from we need to aim at 2% to we need to aim at 3% and maybe above that for a while, well, that could change the outlook with respect to where interest rates should be, which means that variable rates become really, really attractive on mortgages versus fixed rates, which is what we've been saying all along, is that there is I wouldn't call it a high likelihood, but there's just as much chance that we're going to see really low interest rates into 2023, 2024, as there is seeing an increase in 2022. Now, that is just my opinion. It's one economist's opinion, and that is it. But we could very well see low interest rates for a long period of time, meaning those borrowers who selected variable rate mortgages at 0.5% to 0.75% lower than what the fixed rate counterpart could be are going to do very, very well. And by very, very well, I mean, and this is where it gets important to not focus on interest rate, but to focus on dollars and cents, is if you have a $500,000 mortgage and you got a variable rate at 0.5% lower than what you could have got a fixed rate before, well, that means you're saving $2,500 a year. And if you end up with interest rates remaining low for 3 years, well, guess what? That is a $7,500 savings. And interest rates not only have to go up by 0.5% before you break even, they actually would have to go up by significantly more than 0.5%, probably 1 to 1.2% before you would find yourself in a break-even scenario. So if, given what we now know, which is that the Bank of Canada sees employment as a major factor, and we know we have employment issues in the economy right now, well, and that could lead to lower interest rates for longer, doesn't it make sense to have a mortgage that costs less upfront, locks in some savings, has a lower penalty to get out of later, and ultimately has significantly more flexibility, especially if there is some sort of a correction in the market and you find yourself in a position where you need to sell your house? Because the one thing that is going to put more people underwater than anything else is the fact that big bank 5-year fixed mortgages and even 5-year fixed mortgages at monoline lenders, although not to the same extent as at the big banks, have big penalties. And therefore, that is the fastest way to have to give a whole bunch of your equity back to the bank and ultimately end up underwater and not be able to sell a property, or potentially have to give the keys back. So this is just really good news for variable interest rates. It's going to be interesting because it means that the Federal Reserve Bank and the Bank of Canada could be accepting that higher inflation for a longer period of time is going to be acceptable. They could start aiming for that 3% instead of 2%, which means lower interest rates for longer, lower borrowing costs for longer, and ultimately it potentially could look like something that happened in the 1990s in Japan, or the 1920s to the 1950s in North America, where when interest rates get really low, they stay low for a very, very long time because it becomes significantly harder to get an economy back on track when you have very little room to move with respect to interest rates. Now, if you are in the market for a mortgage and you want to know all about how to get the lowest interest rates, we have just the thing for you. It is a course called Secrets to Getting the Lowest Interest Rate. It teaches you all about how to find the lowest interest rate, where to find the lowest interest rate, what the margins are that are available to be negotiated so you can get an even lower interest rate, and how to negotiate with a bank, how to negotiate with a broker, and most importantly, all of the things that come along with getting a big bank mortgage or getting a mortgage that is at a discount broker and having all sorts of landmines and surprises involved in that transaction because you focus only on interest rate and don't realize all the things that come along with discount mortgages and big bank 5-year fix. So it has all of that information in it. We've priced it so low that anybody who takes that course guaranteed will get the value out of it, at least 10 to 50 times the value. And in fact, there is a coupon in that with Mortgage 360 that will allow you to get a minimum of 10 times your money back just for subscribing to that course if you choose to get your mortgage through Mortgage 360. And if you don't, we understand not everyone can get their mortgage through Mortgage 360. That's fine. What's important to me and my why is that everyone gets the information they need to be able to negotiate with their existing bank, their existing broker, and not get taken advantage of. So there will be a link in the description below, along with a 50% off coupon for that course off the already discounted price. And I sincerely hope that you will join us and allow us to help you and engage you in that journey. If you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. I sincerely hope that you, yes you, are the winner, but you have to subscribe to win. We'll see you on the next video. Cheers.